Michael Hainsworth. It's time for an uncomfortable conversation, one that will make you a better investor. Today, investment industry titan David Fingold on why the best investment insights often come from the kinds of conversations you can't have in polite Bay Street company.
If there was one thing you wanted the listener of our conversation today to walk away with, what would it be?
Well, to be flexible and open-minded. Rohit Sehgal, who was our chief strategist for many years, said those were the two most important things in investing. Ned Goodman, our founder, always said our job is not to be the index, it's to beat the index. We can't promise that over every time period, but certainly we expect to do it in the long term. And I think that if you're optimistic, flexible, and open-minded, you're going to find opportunity. I don't know if you're going to find opportunity by doing the same thing as everyone else.
David's insights coming up, but first. When we last talked about dollar cost averaging, it was about why. When markets feel uncertain, investors reach for clarity. But that's exactly when timing becomes dangerous. Dollar cost averaging is not just about smoothing volatility. It's about structuring risk. You're at that age where you may soon receive an inheritance. A good advisor will suggest staging investments over 6 to 12 months, not because it guarantees better returns, but because it reduces sequencing risk. Invest too early and a drawdown hits your full capital. Invest too late and you may miss the recovery. So let's split the difference. Meemaw left us 120 large. Instead of one trade, a strategic advisor would deploy $10,000 a month and allocate with intent, roughly 60% to global equities, large caps, international exposure, maybe dividend stocks depending on your age, 30% into fixed income if you're younger, short duration bonds or investment grade credit, they are a real anchor for volatility, and up to 10% in alternative assets like infrastructure, real estate, private credit. But we automate the schedule because the biggest risk to dollar cost averaging is not the market. It's stopping when the headlines get worse. Weak investors treat dollar cost averaging as permanent. It's not. It's a transition strategy. Once the capital is fully deployed, averaging and start rebalancing is something that you stop doing. That's how you maintain discipline without diluting the long-term returns. So think of dollar cost averaging as a bridge from cash to conviction. Because in uncertain markets, the goal is not perfect timing. It's about being invested long enough for the heavy lifting to be time itself.
You've told me that the things you can't talk about in polite company are the ones that are going to provide you with the best investment insights. How so?
If everybody's in agreement on something, it's probably going to be fully priced. I mean, that is ultimately reality. And when I think about where our sell discipline has been very effective, where our buy discipline has been very effective, it's deciding when a consensus is wrong. All of us, use banks, use insurance companies, think they're incredibly important to our lives. Think they're the bedrock of the system, and that may all well be true. But people were way too complacent in the period leading up to the global financial crisis, and people were way too pessimistic in the aftermath of the global financial crisis. In my own case, we made a decision as the crisis unfolded to move to the sidelines and exit financial services nearly completely. We also made a decision that was not easy to not go in and bottom fish aggressively in 2009 and 10. The reality was, if you went and looked at the relative performance of banking, insurance, capital markets, your actual entry point for sustained outperformance was more like 2012. Literally, people had started to forget about the financial crisis when the opportunity began to unfold, in those institutions. And they're not comfortable conversations because, there are people who are saying, well, I can never go back. I mean, look what happened during the crisis.
Then let's talk about what is uncomfortable to talk about today? What are you hearing? What are you not hearing that gives us an investment edge?
Well, software. The biggest pushback that we're getting today is people who are used to using application software, thinking the companies that produce application software are important and that they can grow in the future. Now, look, I could be wrong about this, but when we look at the performance of the software industry over the last year and a half and compare it to historical circumstances where an industry went out of favor, the best case scenario is that it market performs for the foreseeable future. But there is actually an existential threat here because you have businesses that have adapted the way how they work to accommodate application software instead of writing their own software and having the software automate the processes they want to use to run their business. And I'm literally quoting, in this case, the president of a domestic privately owned transportation company who told me that his team had written all the code they needed to run their business. They've gotten rid of all packaged software and that they were using bespoke programs that automated their processes, and they weren't accommodating the incumbent software vendors who they fired. It rhymed with my own personal experience because I spent 6 years working in a steel mill. And we really didn't buy packaged software. All of our production control, our general ledger, scheduling, payables, receivables, et cetera, were applications we developed ourselves. And people are asking the existential question, which is, should I change how I run my business to accommodate my CRM system? And I can say the same thing about IT support dispatch software. Do I really need something? If I have an email system and I can have a large language model read the emails, can't I generate my own tickets? Can't I track a circumstance where somebody can't log in or their computer won't do this or that and dispatch a service person? So, you have a whole industry that might be worth a lot less than people think. And again, I could be wrong, but I have an open mind towards this. And most people freak out on this suggestion that application software companies have seen their best time.
Is this the uncomfortable conversation we're not having yet, that SaaS is dead?
Look, it's possible, but I'm going to make it sound a little bit murkier. What if on the margin, there are more and more people who are realizing they can write their own code? It reduces the total addressable market for the incumbent SaaS software providers. It means that for the people who are thinking of switching to an internal solution, maybe they go back to their SaaS supplier and say, maybe you should give me a lower price. So there are real dangers when an industry stops growing. We've seen that with what happened to the white pages and yellow pages industries. Ned Goodman, our founder, would talk about buggy whip businesses, and anybody who rides horses knows the tack and saddlery industry still exists. It's just a lot smaller than it was, before the automobile, and, people no longer needing a horse and a buggy and a whip, to get to work or go wherever they're going. So this is sort of the risk that is faced here, is that what if the application software market does not grow because people are considering replacing it with internal solutions? But I will tell you, it's very compelling from my perspective to have exactly the kind of bespoke software you want than to accommodate somebody else. Because I've seen way too many businesses over the last 30 years changing how they operate to accommodate a piece of software. And I think the only time, we actually anywhere in our portfolios own companies that sell software is where the software is inextricably connected with hardware. So this is very counterintuitive, because when I studied IT in school, they put forward the idea of hardware independence, that software should not be dependent upon the hardware. And I think the counterintuitive thing is that the people who've succeeded are the people who use hardware dependence. In other words, Apple's got a great operating system, and part of why it works as well as it does is because they know exactly which hardware they've put into their devices, and a lot of that is their custom silicon, which they don't sell to their competitors. They use that as a point of differentiation, and they create a kind of a walled garden. There are companies we own that are in industrial products and make capital goods, and the way most machine tools, or really any kind of capital goods, actually work is they're generally under the control of software. The software is custom, and because the devices are under internal custom software control, they're highly customizable. And that also allows you, when you find a problem, to fix them very rapidly. And I'd even go so far as to say that from a cybersecurity point of view, and again, I may be over my skis here, if your code is custom, a hacker would have to get your code and analyze it in order to hack you. If your code is the same as everybody else, then you're just as vulnerable as everybody else.
The best investment ideas are not always found in polite agreement. David Fingold argues that when the consensus says the world is safe, an industry is finished, or a category can only keep growing, we should start asking ourselves whether the market has priced in the wrong future. That takes us from uncomfortable conversation to the process behind that conversation. But I'd like to now dig into how bottom-up investing works, how to find great businesses when they're out of favor, and why the company is not the same as a country, its index, or its latest political headline.
I think that the important thing to understand about what we're trying to do is we want to buy good businesses, in fact, great businesses, when they're on sale. If that doesn't evoke a memory of Warren Buffett, then it should. He used to always say that he wanted to pay a good price for a great business instead of a great price for a good business. So the process is inherently value investing. What we try to do is to find companies that we think can be the future leadership in the market and get them when they're on sale, get them when they're out of favor. What we want to do is to get them at a time where the downside potential risk is relatively minimal, and that there's a risk return skewed in favor of making profits. That's a very simple way of talking about bottom-up investing, is we're going one business at a time. From a top-down point of view, though, we have to consider the risk in each one of our investments to what may happen from a macro point of view. So top-down risk management means let's look at each one of the companies and see what affects their business success. Are they affected by currencies, commodities, interest rates, trade barriers, regulation? And let's research all of those things and determine that in reasonable worst-case scenarios, do we face significant downside risk? If we do, then it makes no sense at all. But if within reason, based upon our forecasts for what's going to go on from a macro point of view, these businesses can do well and perform as equities, then we invest in them.
Bottom-up suggests that you start looking at an individual company. Top-down suggests you start looking at a region or an industry. How do I, as an individual investor, start focusing on an individual company if I don't start by focusing on the sector or a region and working my way top-down from there?
It's a perfectly reasonable question, and the way we find companies is by way of a screening process. So one of the things we will do is to just quantitatively look for companies that have been long-term outperformers but are going through a period of underperformance.
So it's not a function of, what do you think of Japan today?
Well, let's say for the sake of argument, I like Japan. You have to ask a rhetorical question: how would you even play Japan? Because if I invest in a Japanese company that makes industrial gas turbines or makes equipment for the cath lab for cardiovascular procedures, the only thing they have in common is that they're based in Japan. Well, that has nothing to do with the Japanese economy. Even if I invested in a Japanese bank and Japanese banks do a lot of business in Japan. They also are lending money to Japanese multinationals who are doing business all over the world. So they're going to have big US dollar denominated loan books because the US dollar is the currency of international trade. So the idea that a company is somehow related to the country in which it's incorporated is inherently a counterfactual idea. Think about it as a Canadian. When Northern Telecom was over 30% of the Canadian market, and all IT revenues as a percentage of Canadian GDP were under 10%, how did the Toronto Stock Exchange Index remotely resemble Canada? The companies are not countries, indices are not countries. Now, if we were talking about Japanese sovereign bonds, if we were fixed income investors, okay, then let's talk about Japan. But we're not talking about Japanese government bonds here. We're talking about businesses, and many of them do business all over the world.
Then what about politics? You've told me in the past, Trump doesn't matter. You don't find leads based upon what any given political leader says.
It's possible, for example, that it can create opportunities. I've seen politicians go after particular industries where they had no legal authority to go after the industry, and that created an opportunity. For example, there are several members of Congress who went after the credit card companies for interchange fees over the last 20 years. And many of those times it created an opportunity because ultimately Visa and MasterCard are payment processors. They don't earn interchange. Banks earn interchange. So if it was a problem at the time, it would be an issue for banks and not for Visa and MasterCard. So that created opportunities. So sometimes we look for politicians to shoot off their mouth and say, do they even have the authority to do anything to stop this? And it can create a buying opportunity. So political noise can create opportunity. I do believe that an important part of what we have to do is to understand the powers of government. Mr. Buffett on many occasions has talked about how little power the American president has and the opportunities it's created within markets. And I can also tell you, I'm one credit shy of a dual major in American studies. I have a Bachelor of Science in Management, but I took every course other than one in American studies at Babson. And, you ask about the president. The president has very, very little power. And I think that this is very confusing for a lot of people because they assume he's the most powerful individual in the world. But I think that they don't understand the checks and balances installed by the framers of the Constitution, by the founding fathers. Now, it can be very different when you're talking about another country, where there isn't an entrenched constitution and an executive can lead by fiat. As a generalization, those tend to be emerging markets, and it's not my job to invest in there. We are developed market investors, and the countries we invest in are liberal democracies, whether they recognize it or not.
I think we would fall down a rabbit hole if we got into the discussion about whether or not checks and balances are an effective tool at the moment for managing risk when you invest in any given region, particularly one south of the border. But I do tie into what you're saying about Warren Buffett, which is you buy stake when it's on sale, and you're looking for signs that the stake is going on sale.
Yeah, we talked about quantitative screening to find ideas. There's also what I'll call the qualitative side of it. There's sort of two ways to come up with an idea qualitatively. One of them is from our network. I've been doing this quite a long time. It's probably over 35 years since I got out of business school. There are people we know all over the world that do investment banking research and know what kind of companies we're looking for. So we'll talk to them. We talk a lot to the companies we own and the companies we might be interested in under the right circumstances, and ask them what's going well for them and what's going poorly for them. If something's going well for them, we might look for second order or third order beneficiaries. If something poorly is going for them, we might also be looking for who is benefiting. And then the final method of screening quantitatively is the media, because Michael, you're a professional journalist, very disciplined, but as a generalization, the media tends to be extremely alarmist, and that has a tendency to create opportunity. They'll, say something's completely over for a company because they've had a bad quarter, or a whole industry is going to be driven out of business. I mean, I can't tell you how many times I've read that about the tobacco industry. And I will tell you that very frequently, the quantitative and the qualitative will align at the exact same time. That is, that somebody will, print a headline about the tobacco industry that makes you think it'll never, perform ever again at the exact same time that the valuation is attractive.
So David screens for long-term outperformers in a period of underperformance, using networks and company conversations to find out which enterprises benefit from that underperformance, and watching for alarmist headlines that may create a contrarian opportunity. But buying a great business on sale is only part of the discipline. Let's now worry top-down, as Fingold says. The top-down risks that can change the case for owning a stock, from credit spreads and yield curves to commodities, regulation, and whether management really matters as much as we think.
You have said that you don't ignore top down. You do pick stocks bottom up, but you worry top down. What does that worry look like? And let's extend that example of the software as a service industry. You've kind of gotten into that already to a large degree, but if you were holding shares of SaaS-based companies, how do you worry top down?
That's a tougher one, because normally when I talk about top-down worry, I'm talking about currencies and commodities and regulation, trade barriers. So it's very easy as an example to say, if we own an oil company, should we be concerned if the price of oil is falling? Anyway, the answer is absolutely yes, because there's a macro factor for us to worry about. Software is a tougher one. I will tell you that there is a relatively strong correlation between the valuation of software companies and credit spreads. As a generalization, when credit spreads are widening, software company multiples fall. We'll have to see if that's the case in the future, given how beaten down they are already. But historically, that would be the way that we would look at it. And I'm not even sure I could give you a causality other than to speculate that because it's a business expenditure, when credit is becoming more costly, businesses are reining in, they're seeking to spend less, they're trying to improve their margins in a slowing environment, and they may be less likely to spend money, and therefore it could come at the cost of the growth of capital investments like buying or investing in a new piece of software.
So top down is important for risk management. Let's talk a bit more about some of those key things that you're looking at. Are you looking at the CEO? Does the CEO matter when you're making a decision about an investment, and you take that top down approach after the bottom up determined this was a company to look at?
Well, I would say, first of all, who management is, I would consider to be bottom up. And management is important. I just think that it isn't all important. It's important, first of all, to understand no single individual actually runs a business. I think that that's a delusion many people have. I mean, certainly, we went through the loss of Steve Jobs as Apple investors, and, obviously an incredibly important individual for the success of the company. But there were people who felt they couldn't be there with the potential of Steve being gone and then ultimately gone. And, I think if you're a great manager, you build a great team.
So if bottom up helps you make a buy decision, does top down help you make a sell decision?
Well, yes, absolutely. I mean, I can tell you that when the curve completely collapsed at the beginning of 2020, and it caused us to go to the sidelines with the banks, there'd been a steepening at the end of 2019, and then the curve started to collapse. In fact, I think I remember that everything, like basically every bond tenor, got below the Fed funds rate before the Fed stepped up and started cutting. So there was I think there was a flattening, and then there may have been a very mild inversion of parts of the curve versus Fed funds. Anyway, that is just really, really bad for banking, and that moved us to the sidelines. And similarly, we had another event like that, where there was an inversion, I believe, in 2022. So, the answer is you don't want to own a bank with an inverted yield curve. Another thing worth keeping in mind is you don't want to own an oil company if the price of oil is plummeting. Ned Goodman, our founder, would always say that if you're going to invest in a mining company, an oil and gas company, you need to first forecast the commodity. You need to justify a higher commodity price. And then you need to use a bullish commodity price forecast in order to value the company. So that's just, an element of open-mindedness and setting aside ego and just saying, if I'm going to invest in a copper miner, why should the price of copper be higher? Why will it stay higher? How can it be higher than expectations? And then we want to try to find a company that's got the best geology and hopefully will discover more and can produce more. So then that combines the top down, the bottom up. But I'm not going to BS you. If I own the best copper mining company in the world and copper plummets, I know it's not going to do well. And also, to be blunt, they say copper is the commodity with a PhD in economics. A plummeting copper price, especially the copper relative to gold ratio, is the capital market saying there's something really wrong with the economy.
If there was one thing you wanted the listener of our conversation today to walk away with, what would it be?
Well, to be flexible and open-minded. Rohit Sehgal, who was our chief strategist for many years, said those were the two most important things in investing. Ned Goodman, our founder, always said our job is not to be the index, it's to beat the index. We can't promise that over every time period, but certainly we expect to do it in the long term. And I think that if you're optimistic, flexible, and open-minded, you're going to find opportunity. I don't know if you're going to find opportunity by doing the same thing as everyone else.
David, it's always great speaking with you. Thank you for your time and your insight.
You're welcome.
If this conversation about the future of software companies in the age of vibe coding via AI was uncomfortable for you, that's great news. It means you can now focus on why your investment may no longer be appropriate, where else to deploy your capital if necessary, and why you want to make that decision bottom up and then worry top down. I'm Michael Hainsworth. Now you're on the money. Thanks for joining us.